Hi everyone, it's Susie again from Esoteric Trading Solutions. I hope you're all well. Hope you're living the life that you want to live. You're being kind to yourself, kind to your family and friends, kind to your animals definitely, and just generally kind to people to make this world a kinder place. That's my esoterictradingsolutions.com sign up for new subscriptions and anything you'd like answered, or reviews on different coins and that sort of thing. We do quite a lot of reviews, which I send to my subscribers in the subscriber channels. We do trading stuff, we put on positions, we do all sorts of things. So there's always a lot of information in those channels that we provide to our subscribers on a daily basis. What I'd like to talk to today is how financial markets are interconnected. And literally all financial markets are interconnected. And just, it's quite in depth. But also I'm thinking about doing a live screening. I haven't done one before. And if I do it, it'll be in the next sort of couple of days. I'll give you notice. And you can pretty much ask me any sort of questions related to markets. And I'll endeavour to answer those questions. And pretty much that. So when we talk about financial markets, we're pretty much talking about the professional markets, being the cash markets, the fixed interest market, which are bonds, corporate debt, the cash markets, which are money market type securities, negotiable certificates of deposit, bank bills, term deposits, 24-hour cash, 11 a.m. cash, that sort of thing, fixed interest, government bonds, corporate bonds. We're talking about floating rate notes, mortgage-backed securities. There's a lot of different type of fixed interest when we talk about fixed interest. It could be even floating rate notes within that, all sorts of securities within the fixed interest market. The equity market, as you know, is shares. It could be ordinary shares or perpetual shares. It could be shares that have different characteristics. We have the property market. We also have the foreign exchange market. We have the commodity market, and as well as the latest and newest market being the cryptocurrency market. So all these markets are connected, and I just want to have a discussion about that. And with my live YouTube, when I do that, I'll be discussing this and just how markets are interrelated. It is a little bit of economics, but also I'll deal mainly with cash flows as well. So let's just start, say, with the cash market. I'll be talking specifically about the Australian cash market, but it's very similar to the US cash market with the US Federal Reserve. So the cash market in Australia, and this is the professional cash market, the Reserve Bank of Australia will have dealing intentions every morning with all the banks, which obviously deal with the Reserve Bank of Australia, and also have exchange settlement accounts, which you've heard me say before. Excuse me, I was quite thirsty. And those exchange settlement accounts, every bank, every building society and credit union will have a balance with the Reserve Bank of Australia, and that balance has to be in credit within the system by 4:30 that day, 4:30 p.m. But the next day in the morning, the Reserve Bank will post a system figure for whether the system, the money market system, if you want to call it that, or the banking system, is in deficit for the morning or if it's in surplus. In other words, how much money is in the system. So what they'll do is they'll report their intentions on the day, their dealing intentions, and that'll get reported on professional dealing room screens, whether it be on Bloomberg or Reuters Cash Page, or even, it used to be Night Ritter or Tellyrate or something like that. And on the Reuters page, it used to be RBAU, but it'll be on Bloomberg page, and it'll be the dealing intentions of the Reserve Bank of Australia. And that will get reported at 9:30 in the morning. Now, if the money market system or the cash system is actually down, and it's down quite a lot, say it's negative in deficit by, say 500 million or something like that, or $1 billion, the Reserve Bank will make their dealing intentions known, and what their dealing intentions will be is to buy securities and do repo into the system, intraday repo or term repo, or overnight repo. So effectively what it's doing is they will provide cash to the banks, the building societies and the credit by buying securities, government securities specifically, or other sorts of state government securities, but it's mainly government securities, and they will do intraday repo, term repo and overnight repo. Overnight repo and term repo are pretty much the same. So when the Reserve Bank of Australia, say, buys a government security off, say, another bank, say just, ABC Bank, the ABC Bank might have a government security with a maturity rate of, say, 2025. They might have, 10 million of that or 50 million. That bank, ABC Bank, will sell that to the Reserve Bank of Australia, and the Reserve Bank of Australia will give them cash. And that's how they get cash. If that bank doesn't want to sell the security, but they just want to lend it to the Reserve Bank for cash, they will do an intraday repo or a term repo. So in other words, what the bank will do is basically, it's almost like a sale and leaseback agreement, or a buy and leaseback agreement, something like that. In the stock market, it's called stock lending, but in the bond market, it's called the repurchase market. So basically what that bank will do is sell that security to the Reserve Bank on a very short time frame and will receive cash in exchange. And that's why sometimes the Federal Reserve or the Reserve Bank of Australia are known as the banks, are known as the bank of the lender of last resort, because the banks can always go back to the Reserve Bank of Australia, which is the central bank of Australia, of the government, of the federal government. The banks in the system can always go back to the Reserve Bank and borrow money. Okay. Now, what they'll do is they'll sell that government security on a short-dated repurchase agreement. It could be intraday, which means they only need it during the day, and they'll give it back at the end of the day, and they'll get their government security back and give the Reserve Bank back the cash, or they'll decide to do a repurchase agreement for overnight. And what that means is the ABC Bank will sell that government security to the Reserve Bank and in exchange get cash from the Reserve Bank. They will borrow that cash at the 11 a.m. rate plus 25 basis points. At the 11 a.m. Borrowing rate plus 25 basis points. So it is more expensive to borrow from the Reserve Bank, but they know they'll always be able to get the cash. So they could do an intraday repo, which gets paid back at the end of the day. They borrow it in the morning and they pay it back in the afternoon because they know they've got cash flows coming in the afternoon. Or they could do a term repo overnight or for a few days. Because it's more expensive, excuse me, to borrow cash from the Reserve Bank of Australia, because you're paying whatever the borrowing rate is for the 11 a.m. rate plus 25 basis points. Most of the time, ABC Bank or any of the banks will do very short-term repurchase agreements. Okay, so that's pretty much how the banking system gets money into the system. Now, if the banking system is in major surplus, then the Reserve Bank of Australia will give their dealing intentions again in the morning the next day, and they will basically, their dealing intentions would be reverse repo or selling. They would be selling government securities. So if the Reserve Bank was selling government securities, they'd be taking money out of the system, because I'm a bank, I buy the government security from the Reserve Bank. And if I'm buying the government security, I'm taking the security and I'm giving the Reserve Bank cash. If I do a reverse repo, it's the reverse of what I did yesterday. I'm basically buying the security and giving the Reserve Bank cash. So the direction is still the same way. The money is coming from the banking system. It's going out of the banking system back to the Reserve Bank of Australia, if that makes sense. And that's pretty much how the Reserve Bank of Australia monitors and affects the flows in the banking system. Now, once the money gets in the banking system, which is the cash market, which is the first market on our list, all the other markets can be affected just by that interaction with the Reserve Bank of Australia, the cash market. Because on the day I'm ABC Bank, I effectively borrowed money from the Reserve Bank. I might have borrowed that money for a term, for a couple of days, and so now I have money in ABC Bank. I'm the treasury person sitting on the desk, and now I've got money, in my fund, in my bank account for ABC Bank. Okay, so basically that's pretty much what happens. So again, the Reserve Bank of Australia, just going on this, will effectively give us money in the system. I'm the bank that receives that money. That cash money might be 110 billion, and that money is then, the bank receives that money, and other banks receive that, and that money could be lent out to an internal department within the ABC Bank. Me as ABC Bank could lend it out to another bank, and I could also lend it out to another bank. So say, for example, I'm ABC Bank. Of the 110 bill that I borrowed from the Reserve Bank of Australia, and I gave them securities and they gave me cash, I can then now, with that 110 billion, me being ABC Bank, lend that to my lending department, internal to the ABC Bank, internal lending department, who will then say, I lend them 45 billion. They will lend that, that'll go to my lending department, and all the salespeople and the mortgage brokers will sell mortgages for housing, and that'll affect the property market. So the property market gets affected just by my interaction as ABC Bank with the Reserve Bank. So going back to this diagram here, so my internal department, the lending department, has 45 billion of the original 110 billion that I borrowed from the Reserve Bank. And that will go into the property market where there'll be clients. My lenders will have clients where they'll actually lend out money for them to buy houses. I also, of that 110 bill, I might lend that money to Bank B, which is another bank, but I have settlement limits with, I have a credit limits with, and I can lend that money to Bank B. Bank B will borrow 60 billion from me. They'll pay me an interest rate, and Bank B, will lend that to their clients. Say Bank B lends, say $60 billion to one of their high ultra net worth clients in private bank. Their high ultra net worth client will borrow 60 billion to, say, invest in the equity market, the crypto market, or the bond market, say, for example. And that would get distributed between the equity market, the crypto market, and the bond market, just from the original transaction of ABC Bank dealing with the Reserve Bank in the morning. Also, me as ABC Bank, I've lent out 45 billion to bank, to the internal lending department of my bank, ABC Bank. I've also lent out 60 billion to Bank B, who's then lent it out to their own private client, an ultra-rich, high-net-worth private client, who borrowed the money to basically invest in the equity market, the crypto market, and the bond market. And then, me as ABC Bank, I've lent a further 5 billion to another bank who's received the Aussie dollars and now has decided to do a foreign currency transaction, selling Aussie and buying US dollars. So all in all, me as ABC Bank, at 9:30 this morning, I borrowed 110 billion from the Reserve Bank of Australia. Of that, 45 billion went to my lending department, 60 billion went to Bank B, and that went to a very ultra high net worth individual who borrowed 60 billion, say for argument's sake, who was, say someone like Jack Ma from Alibaba or something, who could borrow that sort of money. And Jack Ma decided, for example, this is all hypothetical of course, to invest some of that money in the equity market, the crypto market, and the bond market. Also, the other 5 billion I decided to lend out to Bank C. And what Bank C did with it, it went to their foreign currency department. They sold the 5 billion Aussie and bought US dollars because they believed the Aussie was going down and the US dollars was going up. So in every market that we've spoken about, in terms of financial markets being interconnected, just from borrowing money from the Reserve Bank, every other market's been affected. The fixed interest market, bonds, corporate, equity market, property, foreign currency and commodity markets. Just by that one transaction with the Reserve Bank has generated this multiplier effect within the money market, within the economic system. It's affected the property market, the equity market, the bond market, the foreign exchange market, and the crypto market. It could even affect the commodity market if, obviously one of those transactions was connected to the commodity market. Now, I'll give you an example of this. Say, for example, the ultra net worth high individual invested in the equity market. They could decide to invest in an IPO, initial public offering, of a commodity producer. Say, for example, someone that, is a zinc producer or a copper producer. We have a lot of copper producers in Australia. They could be investing in an IPO, initial public offering, to buy shares in a commodity producer who, again, sells copper forward. And so, therefore, that commodity market would also be affected by virtue of a high net worth, wealthy individual investing some of that 60 billion in the equity market, but in a copper miner that's doing an initial public offering, and they happen to be, they've already got an existing business where they're mining copper and buying and selling copper in the international professional markets. So this is how all markets are interrelated. Excuse me. So just to give an idea, if we only talk about one factor affecting something in terms of financial markets, if we say that, say for example, interest rates rise, interest rate yields, okay? So all of a sudden, one bank, the Reserve Bank of Australia, say for example, they've substantially raised rates because of economic growth. Economic growth's been massive, inflation's going through the roof, unemployment is at near record lows, purchasing power, is not going anywhere because inflation's rising so much. The economy is speeding up and up and up, and they need to slow it down, otherwise they're going to have hyperinflation. What the Economic Bank will do, the Reserve Bank of Australia, will raise rates. And say rates were 1.5%, say hypothetically they decide to raise rates by, something massive like 200 basis points, which is highly unlikely. But in the olden days, that's what they used to do. Before they had like an open market type system where they, told everyone. But say just for hypotheticals, they do raise rates substantially in Australia. What would happen in that situation? This is where markets are interconnected again. What would happen is the foreign currency the Australian dollar would go up against all other currencies. It should be currencies, not countries. Australian dollar would go up against all other currencies, assuming that Australian interest rates are higher than other countries. Okay, so pretty much say if our rates are higher than anywhere else, the Australian dollar would reflect a higher rate compared to another currency. So, the Aussie dollar against the US, the Aussie would go higher. The Aussie dollar against the crosses would go higher. With higher rates in this country, higher interest rates, people and banks would start investing in our term deposits because interest rates are higher. And also they'd invest in our term deposits because they wouldn't want any capital loss in any other financial markets. So not only do we have the Aussie dollar going up because of the foreign exchange market, because interest rates are rising, and all of a sudden Aussie dollar term deposits are better in terms of interest rates than anywhere else. It means that overseas people or banks or whatever have to buy Australian dollars to invest in Australian term deposits. You see what I mean? And with doing that, they have to sell another currency. So it certainly pushed the Australian dollar up, and then they'd invest in Australian term deposits. And that's what we saw a couple of years ago as well. With the rise generally in interest rates, quite high rise, we'd see the Australian equity market would generally come down. Shares, as I said before, are generally valued on a discounted cash flow model. And so with rising interest rates, substantially rising interest rates will tend to push the price of shares down, particularly shares that are very interest rate sensitive to rising interest rates. Now, I'll give you an idea of that. Residential, anything to do with real estate shares, residential type shares or property type shares, utility type shares will tend to fall, because they are, they're long tiered or they're long duration shares. But also property, residential type property, commercial, is very reliant on interest rates not being too high. If interest rates are too high, then the funding costs or the borrowing costs to invest in property becomes too high, and possibly rent is a cheaper option. With interest rates going up, you find the fixed interest markets or the bond markets tend to sell off in terms of price comes down and rates go up. And, investors can endure capital losses. And that's something investors don't like to have, is capital losses. If they invest in a bond, say at 6% yield, and the coupon's at 6% and the par is at 100, and all of a sudden interest rates go to 8% and they need to sell that bond, they've actually endured a capital loss of 200 basis points, and they've actually lost principal. So it's not an ideal situation if they sell the bond before maturity. If they hold a bond for maturity, even if the yield's 6% and the coupon's at 6% paid semi-annual, they won't lose any money. But if they sell before maturity, they would have a capital loss, with interest rates being at 8%. Also, with interest rates going up in Australia, the mortgage rates in Australia would go up. And if the mortgage rates in Australia went substantially up, the property prices would start to fall, the property market, because people have to pay their mortgages. And if they're on floating rate borrowing rates, and they've only got a fixed salary, or their salary is only so much, and their mortgage goes up by more than what their salary can afford, then people are often forced to sell their properties. Now, what we've got in Australia is a lot of interest-only property loans, and if interest rates went up too much, a lot of people have borrowed over and above their disposable income or their income. They've borrowed 133% to their income, and what that means is they're earning $1 of income. But they've got $1.33 of borrowings. So if interest rates went up too high and they're paying interest-only mortgage, they would be forced to sell their property. Okay, and this is pretty much how all markets are interlinked. I will get to the crypto market. I haven't come to the crypto market yet, but I will talk about that. So basically, interest rates rising will affect all markets. And obviously with interest rates rising, people don't like to risk capital losses in other markets or other asset classes if they get out of something before maturity. Even in the commodities market, commodities can be sensitive to interest rates going up. Commodities can come down if the funding rates go too high or the lease rates go too high, and particularly if the commodity infrastructure, say the cost of mining, is subject to interest rate risk, interest rate exposure, then if interest rates rise too much, the cost of that project is not going to be feasible. Also in the stock market, we mentioned this, interest rate sensitive stocks will go down, particularly utilities, residential and infrastructure, and low dividend paying stocks. Now in terms of the crypto market, which is the new asset class, and remember we went back, we had our asset classes: cash, fixed interest, bonds, equity, property, foreign exchange, commodities, and crypto. These are a subset. The main asset classes are cash, fixed interest, equity, and property, and these are sort of like a subset. But the fifth asset class is cryptocurrency markets. Now, with cryptocurrency markets, the biggest question that everyone has is how is the cryptocurrency market going to be affected by the other markets, by these other markets, whether it be cash, fixed interest, equity market, property market, and will it act as a hedge in terms of volatility in other markets? And it's a very interesting question, which is something, you know, I'd like to address as well, because as we know, the cryptocurrency market is a very new market. It's the newest asset class. There hasn't been a new asset class for about 120 years. And the question is, if interest rates rise dramatically, which they look like they are in the US, and the equity market's at all-time highs, and there could be a potential fall in the equity market, and interest rates are rising over in the US, and they're in rate hike mode. The question is, will the crypto markets fare, will they work as a hedge against other asset classes? In other words, if other asset classes come down, will the crypto market not fall as hard, act as a hedge, or, potentially go up? Or alternatively, will it fall in the same direction as other asset classes? Will there be a positive correlation to other asset classes or not, or a negative correlation? Now, you'd like to see the crypto asset market, the cryptocurrency market, having a negative correlation to other asset classes. For example, if interest rates do rise, there is not a positive, if interest rates do rise, you don't want a negative situation happening in the crypto market. Say, for example, if if bond prices are going down and crypto prices are going down at the same time and share prices are going down, then that's a positive relationship. A positive relationship and a positive correlation, and it just depends on how much percentage of a positive correlation is it. Say, for example, if the share market's going down, 90% to interest rate rise, would the same correlation, would it be the same for the crypto market? Would it be positive, and also would it be a 90% reduction? So the question is, does the cryptocurrency market act as a hedge? In other words, it does the opposite, or does it do the same thing? And honestly, at the moment, the jury's out on this, because as you all know, it's still a very small market. We're only looking at 273 billion. We are looking at 1,610 coins and tokens, and again, a lot of them are just scams. Even the 30 that are in the index, still are highly correlated to each other and highly correlated to Bitcoin. I'd imagine the movement of Bitcoin will become less correlated. In other words, if Bitcoin goes down, XRP hopefully will start going up, and other cryptos will start going up. But that correlation will change over time as the market becomes, grown up from being a bub, and as it matures. But it will take some time. But also, how will the cryptocurrency markets fare compared to other financial markets and other asset classes? Again, will it be treated as a hedge when other asset classes are falling? Will it go up? Or alternatively, will it go the same way as other asset classes? There's basically argument for both sides of that debate. Generally, when you find other asset classes going down, there's a lot of volatility in other asset classes. Money tries to find itself a home somewhere else. It'll try and find itself a home in the cash markets, and it'll try and find itself a home in the most secure markets. And when we saw the sell-off of 2008 and 2009 in the equity market, which was quite vicious, and I was working as a stockbroker at the time, it was terrible. What happened in Australia is money found itself in the cash market, with all the major banks. The smaller banks couldn't get any money and they nearly fell over, but also it found itself in the property market. So people went into the safest markets. So in times of volatility, when equity markets are coming down and currencies are incredibly volatile and commodities just keep falling, which is what they did, will crypto markets do the same thing, or will they be seen as something else? And really it's a bit early to know. But in saying that, crypto markets, cryptocurrency markets, there are a lot of different sectors in the cryptocurrency market. And I suspect as time goes on, it'll act more like, the different sectors within the stock market. So, for example, if a cryptocurrency is in, something like food security, like Ambrose's, it'll be, fairly well hedged against a falling equity market or a falling, currency, or currency increasing, or a very volatile commodity, or whatever it might be, or interest rate rises. If a cryptocurrency, say, for example, in artificial intelligence, it should be a hedge against, a very volatile equity market or a very volatile bond market, for example. As the cryptocurrency matures, as the cryptocurrency market matures and gets a lot more mature and there's more professional players in the market, it should become more like the stock market, where even when the stock market goes down, not all stocks within the stock market will go down. Some stocks will still go up, and you might have 90% of stocks going down, but not all stocks will go down, even with the market going down. So it's going to be very interesting to see where the cryptocurrency market goes, but it will, as time goes on. You'll have areas within the cryptocurrency market in terms of cryptocurrency selection, where some cryptocurrencies will perform a lot better than others, and they won't go down by as much when markets are getting sold down, and they'll perform very well, even better, when markets are going up. And they're the sort of cryptocurrencies you want to be in. Now, just finishing this up, and I'd like to do like a live chat just to read all this stuff, and if you've got any questions, please do ask me. So I'm thinking about doing a live chat, but I will send like an event for that. I'm still trying to learn how to use live chat, so just bear with me on that. I'm still a bit scared of it because it's technology and I don't know a lot about technology. But talking about all these markets, every one of these markets, these 5 major asset classes or financial markets: cash market, fixed interest market, equity market, property market, and these markets here, foreign currency and commodity markets, and then the crypto market, they all have a settlement problem. The whole world has a settlement problem. I have a settlement problem. You have a settlement problem. Every asset class, every person in the world has a settlement problem. We do not get our cash flow instantly. Financial markets, prices go up and down instantly. I send an email, you get it within a second. Everything's instant, but the whole world has a settlement problem. In other words, we do not get our cash straight away. So even in all these markets, as you can see, cash 1 to 24 hours, bond market 2 days minimum, property market 30 to 90 days to get your cash, equities, borrowing, could be a minimum 30 days, equity trades 2 days cash settlement, FX 2 days to 12 days, people could be 2 days to longer. Again, all these markets have a problem getting cash flow instantly. Now, in times of volatility, when we see markets imploding and everything selling off, cash becomes king. And honestly, you need to be in technology that works and settles instantly. And in saying that, the only technology that I know that settles industry instantly in volume, against cross-border flows and everything else is Ripple. And basically, XRP. So, and honestly, you know, the regulators really need to know what they're doing, because seriously, the equity market looks quite vulnerable to me, and I think we are going to see more volatility, and it's going to be very interesting to see the correlation in cryptocurrency. And also with the, you know, some argument to even say with the delay in cash flow settlement, it could be increasing the volatility in financial markets as well. Anyway, look, it's food for thought, guys. I only you know, talk about this for you guys to have a think about it. This is for education only. Of course, I've got the disclaimer there, the you know, disclaimer. But, you know, there are a lot of things to think about when we talk about different markets, and there are so many issues. And I'm thinking about doing a live event just on all this. So there's a lot of questions. If you'd like to ask them, please by all means do. I'll send out an event note, and just bear with me, read the technology. So I hope I can do it. Anyway, please look after yourself, everyone. Be kind to yourself, be kind to your family and friends, be happy. Life's really short, really short. I know how short it is, seriously. Also, what else? Just be nice to people. Please make this world a better place. There's just too much cruelty and too much horror. But anyway, just try and make it a better place. I certainly do. Anyway, take care, guys, and I'll talk to you very soon. Thank you, Susie.